and welcome to our next lesson. So today we're going to be looking at price setting power and monopolistic market structures. So here we've got our quantity, and I already worked out the total revenue for you because actually it's these two columns that we're most concerned about. But you can see here that this firm has price setting power. So as the quantity is increased, the price is changing because the firm is able to decide that the price is going to change. And there are several reasons why as the quantity goes up, the price goes down. I'm just following the fact that as the firm is producing more, they're able to benefit from economies of scale and they're going to pass that on to their consumers. Now, firms have different degrees of price setting power, and actually this is quite a lot of price setting power, more price setting power than you would find in a monopolistic market structure. But that's kind of beside the point because I'm just going to illustrate a few things. So I'm hoping to be able to prove a few things in this video to you to kind of solidify a lot of your learning, and as always, kind of ask as many questions as you like. So as I said, I worked out the total revenue here already, kind of put it all up on the board. So we're going to have a look at the average revenue now. So obviously we work out average revenue by just taking total revenue, dividing it by quantity, and as we go down you can see that actually that's equal to the price. So 100 divided by 10 is obviously 10, 180 divided by 20, and then 8, 7, 6, 5, 4, 3, 2, 1, and then obviously 0 here. So this might seem like completely obvious, but it's actually illustrating an important point here. So one, this is why average revenue is equal to the price in perfect competition, because the firm is a price taker, it just accepts the market price. Doesn't matter what quantity they produce, the market price is always the same. And also it illustrates the kind of point here that our AR is obviously downward sloping. And remember that when we find our price, we go up to our AR and across. And that's why that equals the price right there, because your average revenue is equal to the price here. So next we're going to have a look at our marginal revenue. Now we know that marginal revenue is just the additional revenue from producing one extra unit. So for here, obviously you have to divide it by 10 here because this is a difference of 10 units rather than just the 1 unit. So our total revenue here has increased, and then you obviously need to divide that by 10. So you can see here that this one is obviously 80. We're going to divide that by 10, which gives us 8. And if we do that all the way along, obviously here this is going to be 6. And then for this one here, it's going to be 4. And then 2, and then for this one here, this is 0. Now here, obviously, 300 to 280 is actually minus 2 because that's 20, but your revenue has fallen by 20, then you divide that by 10, so we've got minus 2 there. Following on here, minus 4, minus 6, minus 8, and so on, minus 10 here. So this is also going to illustrate a really important point to us. So we know that our average revenue is 0 at 110 units, so I can actually kind of touch this here at 110 units, so we can call this our AR. Don't worry, we're going to look at this in a lot more detail in just a moment. But also, we can see here that our marginal revenue is 0 somewhere kind of halfway along here. So I'm going to guess at 55. I actually know that it's 55. So I know that my marginal revenue cuts through zero, it actually continues into negative, whereas our average revenue just hits zero. And that happens halfway across here at 55. And I just kind of wanted to take a moment to prove that to you here. Now we know that in theory why this works as well, and that's to do with elasticity here. So we know that this section of our demand curve is elastic, and this section of our demand curve is inelastic, and therefore it makes logical sense for marginal revenue to cut through halfway when it's neither elastic or inelastic, because actually if you increase the price from this to say P1 here, then you're entering from neither elastic nor inelastic to an elastic period of the demand curve. And obviously if you increase the price when something is elastic, then there will be a more than proportional change in quantity demanded, which means that your revenue will fall. And actually here as well, if you decrease the price here, you actually enter your inelastic section, and we know that if you decrease the price, when it's inelastic, then there will be a less than proportionate response, and therefore your revenue will fall. And then that kind of explains as well why your revenue is maximised at marginal revenue being zero. So just thought it was worth taking the time to do that before we actually look at the monopolistic diagram, which we're going to do now. So this is for a monopolistic market structure. So one of the first things that I want us to have a look at is that AR and MR. So we know that it's going to be downward sloping. We saw that there. You can go back and have a look at those numbers. It's very easy to see that it's downward sloping. But we also know that it's not going to have that much price setting power. So they only have a very small amount of price setting power. It's not that, you know, the corner shop at the end of the road can charge a huge amount more than Tesco's for its pint of milk. We know that that's not true. It's a very, very small amount of market kind of price setting power for those firms. And therefore the AR and MR, you know, kind of alongside, is going to be downward sloping, but not that much downward sloping, like very elastic. So I'll draw that in kind of now. It's going to be very elastic. Now, eventually, just to kind of hit that there, we do know that AR does hit zero, but in this case it will be all the way off our diagram, and we don't need to kind of show that. So we know that this is our average revenue, and our marginal revenue is going to cut through zero at, you know, it's halfway along this AR curve. Now we know that this AR curve goes off in, you know, off my paper here, but our MR curve will cut through zero. And remember, when you are drawing your MR, when they both kind of land on the diagram, your AR should hit at zero and not go beneath it, but your MR does very much cut through zero. I'm not expecting you, nor does the exam board expect you, to cut all the way down, but just a little cut, so we know that you know that it is below zero is fine. So cost in a monopolistic market. Now, we only have perfect competition to compare it to, so it's important for us to think about that. And actually, costs in a monopolistic market are slightly different to perfect competition. If you think about any of those kind of market structures, we know that there are some costs associated, more so than in perfect competition. We know that firms do advertise, you know, not huge budgets for advertising, but they definitely do advertise. The local hairdressers will advertise, takeaway shops will advertise. It might just be kind of a very small local advertising campaign, but they very much do advertise. So because of that, their average costs, their marginal costs are higher than in perfect competition. Now, that's not something that we represent on the diagram particularly, but it's just important for you to be able to know in your mind that they are going to be higher. So our marginal cost is all exactly the same, that kind of Nike swoosh here, and that's our marginal cost. And this is where we're going to use the short run here. So we're going to talk about monopolistic in the short run. So we're going to assume that they're going to be able to make some profit. Now we know that they're going to be profit maximizers. We're going to make an assumption that they're going to be profit maximizers just in their natural kind of course. They may well switch. They can revenue maximize because they do have an MR equals 0 point. We know that in perfect competition that doesn't exist. So, but here it does. We're going to assume that they're profit maximizing because, you know, the majority of the time they are. They might switch for other reasons, but actually for the majority of the time they are. And here we're going to have that quantity of profit maximising. And literally, like I said before, we can go up here and go all the way across. And this is actually our price in the market that this firm is setting. This is not the market equilibrium price. We know it's not the market equilibrium price because we've just shown previously that firms have some price setting power and therefore they're actually able to set prices slightly above the market equilibrium price. I might touch on that and come back to that in just a moment. Now, the reason I've drawn the diagram in this order is just very simply to kind of illustrate to you how you can get it right first time in the exam. So I know that this is in short run. I know that firms can make supernormal profit in the short run. I want to show that on this diagram. So I've already given myself a guide here. I know that my AC needs to cut this line below 8R so I can show that some supernormal profit has been made. It doesn't, obviously we're going to aim for the lowest point to be cutting the AC, not the AR, like that. And then simply here I can show that this is supernormal profit, right there. And here's our supernormal profit being made in the short run. I'm just going to go over a really quick example kind of to put this to kind of solidify it in your brains. So let's think about the corner shop. So corner shop at the end of the road, someone wants to enter that market. So the barriers are relatively low. You don't have to buy a property. You can buy a property. You are able to sell it when you leave the market. If you weren't able to sell it when you leave the market, that is an example of a barrier to exit the market. But I imagine that most corner shops, at least when they first open, may rent. So you're actually only paying for that factor of production, that land, for as long as you're using it for. You can order just enough stock to kind of get you through a month or a couple of weeks, even if you're unsure about the market. So again, the cost of entering that market is very, very low, very minimal barriers to entry. When they do get into that market, they have some very small amount of price setting powers. If they're in a small local area, they can rely on kind of local support. So there's lots of consumer switching. If you're closer, if you have a corner shop that's closer, that opens up to you, you'll probably switch and go to that corner shop rather than staying loyal to your kind of corner shop that's a little bit further down the road. So you've got lots of consumer switching. They've been able to enter the market very easily, got a bit of price setting power. They know that they can charge a little bit higher than, you know, the large supermarket down the road. So they have a tiny bit of price setting power and they're able to make some supernormal profits. And so just to kind of hit on the idea of barriers to exit, they may advertise a little bit, but you know, that's what we call a sunk cost. So it's a cost that you cannot get back when you exit the market. But everything else they're able to get back. If they did decide to buy the property, they could then sell the property afterwards. If they rented the property, they haven't actually lost anything because they've just used that factor of production whilst they were using it. They can sell their stock if they decide to exit the market and they've got some stock left over. They may decide to sell that on either in bulk to the person who rents it next time or to another corner shop, or just sell it and kind of move on at a discounted price. They might move to revenue maximisation to be able to exit the market. So it kind of fits very much within this. Just to kind of go back to this idea of price setting power and what that means, I will kind of just draw a very quick diagram here. So this is an industry diagram. This is obviously our theory of the firm cost and revenue diagram. I'm just going to draw an industry diagram so you can see the impact of price setting power on this diagram and on the market in general. So this is our price. Obviously this is our quantity. Once again, very quick diagrams and I apologise there. This is our demand. and obviously this is our supply, and we have a market equilibrium here. So this is our price, our market equilibrium price, and this is our market equilibrium quantity. Now firms are able to come in, and because they have price setting power, they're able to set their price above the market price. So actually what's happening here is the firm is able, and in monopolistic markets, we'll have a look at this in a lot more detail, especially when we get to monopoly, because this really plays into monopoly actually. But for the firm here, for a monopolistic market structure, it's actually only a tiny bit above the market price. So this is the price for the monopolistic market here, and they've set that price slightly above the market price. Now what that's allowed them to do is to just kind of steal a little bit. Let me grab my other coloured pen. Just allowed them to steal just a tiny bit here of the consumer surplus. I'll actually colour it in properly here. So they've managed to steal this tiny bit of the consumer surplus for their own. So that's the producer has stolen this here. And there is a little bit of a deadweight loss here. Sorry, I've coloured it in red for the moment, but I will just colour it in black. That's the kind of deadweight loss from price setting power. And again, just introducing this concept now because it is something that we're going to have a good long look at when we come to monopolies, even I get confused, monopoly market structures in a good few weeks' time. But just to kind of drip feed that in now so you can understand what this kind of price setting power impact on the industry is. The main thing that I really want you to walk away from this video getting is this kind of diagram here. So in our next video, we're going to have a look at the transition from short run to long run, and then after that we're going to have a look at whether that's actually realistic. So whether the idea of having a short run and a long run in reality is very realistic, because actually monopolistic market structures, unlike perfect competition, absolutely do exist. We had a look at some examples, and therefore we need to kind of look at the reality of whether the theory holds or not. So I hope that you enjoyed your learning, and thank you so much for watching. Cheers!